Good morning, everyone. Today's Monday, March 15th. Got several great charts to share with you guys today. A lot of people have reached out directly and they've been asking me, hey, can you better explain this relationship between interest rates and gold and bond price movements and how this can affect the stock market? Many of you have seen in the news, both on CNBC, Market Watch, Bloomberg, and elsewhere, that there's a lot of concerns about inflation kicking on. And of course, these concerns are legitimate. This first chart that you're seeing here, this is a chart showing the yield, basically the interest received on a 30-year U.S. Treasury bond. And what you can see here in the right-hand corner is that these rates have been steadily going up. We looked at some charts of the 10-year last week. Now, the most important thing to understand is that when rates go up, bond prices come down. And this is just the natural math of how bonds work. I'm going to share an article that breaks this down for you guys after we make this post today so that you can better understand. But to give you guys an example of this, what I've pulled up here is the chart of the TLT 20-year plus Treasury bond ETF. This is one of the most liquid ETFs in all global markets, and the idea is that it tracks the performance of bonds with a maturity of 20 years or longer. It's a very, very popular ETF. Now, what you can see here is the yellow line is the 200-day moving average, and you can see that the price of this ETF has fallen below its 200-day moving average, and it's fallen quite a bit. So if you bought this ETF, let's say that during the pandemic last year, you said, you know what, I'm just exhausted, I don't want to take market exposure, I just want to put my money in someplace safe, I'm going to lend it to the US government and park it in US Treasury bonds. Well, had you done that last year, and let's say you needed to sell that right now, you would be down a whopping 20%. Not the conservative portfolio investment that most people think that it is. So this is very important to pay attention to. As rates come up, we're going to see that it impact other markets. One of our favorite charts, coming from a background doing global macro, is we look at the spread, the option adjusted spread on junk bonds over equivalent US Treasuries. Basically, how much more interest and yield are we being compensated for holding risky corporate bonds, known as junk bonds or high yield bonds? This chart to me is absolutely terrifying. The fact that I'm only getting 3.26% more for holding a risky junk bond is crazy. Now, for perspective here, look at what happened during the beginning stage of the pandemic. You can see that these bonds, the yield went way up, which means that the bond price effectively crashed down. And this was the case until the Fed bailed out all these corporations that had junk bonds issued. So this is very unstable. Now, last chart for you guys today, and then we're going to leave it here, is with all the talk of the stimulus being issued, all the checks going out, there's been several surveys estimating that nearly 50% of U.S. citizens receiving stimulus checks plan to invest that in the stock market. This is certainly not advisable. That's just pure speculation. Putting money into the stock market like that is not a wise thing to do. Nonetheless, I wanted to share a chart of the largest index in the world, our US S&P 500 stock index. But to give you guys a little bit more perspective, I thought it would be fun to show you what this index looks like when we calculate that index in gold. So I'm going to add that right now so that you guys have a little perspective. So, people talk about markets hitting all-time highs. Well, those are all-time highs when based in US dollars. When we look at the S&P index actually adjusted for being priced in gold, we can see that it has not recovered since the late 90s. So we are still well below the historic highs when priced in gold. So looking at real purchasing power, which is what gold helps us preserve, we can see that the markets are a bit of an illusion, not really creating as much wealth as everybody thinks that they do. Anyways, hope you guys found this video helpful today. If you have any comments, questions, or thoughts, certainly share them with us on our chat, and we'll share more with this going on later this week. Thanks.